Markets could be a little bit too optimistic about inflation. Inflation is not easy to curb. Once developed economies surpass the 5% inflation rate, it takes about a decade to bring it down to 2%, according to estimates of Deutsche Bank. In this graph that is courtesy of BlackRock, what we see is that curbing inflation back to 2% would require a very significant slump in gross domestic product. We are seeing in the developed economies, and this is for the United States, obviously, we are seeing that the level of aggregate demand is actually not diminishing as quickly as probably central banks would want. However, what we need to also understand is that when governments that weigh about 50 to 60% sometimes of GDP are not just not reducing demand, but increasing their demand by spending more, then the reduction in aggregate demand is likely to come fundamentally from the private sector. So it is going to take more time to bring inflation down to 2% than what many anticipate right now and probably would want. That is why the message of central banks is so aggressive about remaining within the path that they have set. But let's also have in mind that central bank policy remains extremely accommodative, that they're not reducing their balance sheet yet, that the pace of rate hikes is still behind the curve in numerous cases, and that it's in many cases as well, particularly in Europe and in Japan, they continue to monetize government spending in very significant ways. So let's be at least aware of the fact that there is a risk that inflation may be more persistent, and more importantly, that if government don't reduce their spending, the reduction in aggregate demand is going to come only from the private sector, and that means a severe slump. The Chinese reopening has been one of the key themes for investors to be more bullish about the global economy and more optimistic about growth prospects globally. However, there is something interesting, because the reopening is not showing either in freight costs, which have declined to levels not seen in 5 years, to the lowest level in 5 years, and it's not showing either in commodity prices. It is certainly not showing in energy commodities, but it's also not proving to be relevant enough in the price of industrial commodities. There was a small recovery in those prices, and then they declined afterwards at the beginning of the year. This shows a number of things. The reopening obviously is a reality, but the monetary phenomenon in prices is more important. What this means is that rate hikes and contraction of money supply in developed economies is playing a larger part and has a bigger impact on commodity and freight costs than the reopening of China and the increase in money supply in China itself. That is something that is also evident in industrial production and in the manufacturing sector. The global manufacturing sector, most of developed economies remain in contraction in the manufacturing sector. Therefore, the tension between monetary aspects of prices in commodities and in freights and the reality of the global supply and demand are things that collide. And we have discussed this a number of times. The fundamentals in the commodity market, in terms of 5-year average inventories, in terms of supply and demand in most commodities, very strong. However, the monetary aspect is playing a much bigger role right now. Rate hikes are certainly having a larger impact on commodities and on freight charges than the improvement of global demand coming from the Chinese reopening. Something to look at very carefully, because when we think about inflation, let's remember it's always a monetary phenomenon. Rate hikes matter. In the Eurozone, rate hikes have led to a massive collapse in demand for mortgages in the housing sector. Think about this. In the last 3 months, what we have seen is that the demand for mortgages has been reducing, but not at a normal pace, at a pace that was not seen since the 2008 crisis. If you look at this graph, courtesy of the Financial Times, it's even worse, the decline in mortgage applications, but we also have to remember where it's coming from. It's coming from a very aggressive level of increase in mortgage demand prior. So, this is an important factor. Housing is not a safe haven in this environment, because when inflation rises, usually investors tend to look at housing, tend to look at real estate as a way to cushion the blow of inflationary pressures and to look for safe haven assets. However, when the increase in prices in real estate has been so aggressive and has been credit driven, as it has been in the past years, the inflation cushion that housing tends to provide is all but gone. So what we find is that in an environment of persistent and elevated inflation, real estate does not work as a safe, as a defensive asset, or certainly as an inflation hedge. And we at least have to bear in mind the fact that raising rates plus elevated valuations and the reduction in the level of real disposable income of citizens is certainly going to affect the demand for new homes and for mortgages. Low volatility doesn't mean low risk. In January, we have seen a massive slump in volatility, both in bonds and in the overall volatility index. That means, obviously, that we are in an environment in which investors are looking at risk on as their strategy. That's why equities, bonds, cryptocurrencies are rising all in unison. And certainly the perception that central banks have sort of stopped at least the strength or the acceleration in rate hikes, that they have maintained a more dovish tone in their assessments and that they're going to be more accommodative works. And on the other hand, the idea that global macroeconomic situation is slightly better than expected. So what we have is much lower perception of volatility, much lower volatility in markets, much lower perception of risk, and certainly a much more benign environment, both in terms of the macro environment and the monetary policy. That does not mean that this is all fantastic. We need to be aware that sometimes this works as a very dangerous view of taking too much risk too fast without taking into account what happens afterwards. So basically just be prudent and be aware that the macroeconomic environment remains quite unstable and certainly not bullish, that inflation remains elevated, that central banks continue to tighten, and obviously that we need to be looking for opportunities, but not anywhere at any price. Why does nobody talk about cryptocurrencies anymore? It seems that everybody has forgotten about whether it's time to purchase cryptocurrencies, whether it's time to buy Bitcoin, etc. However, it is true that they have set, at least most of them, some kind of a bottom, and that they are coming back with the rest of the risky assets. My problem with cryptocurrencies in this environment is very simple, is that when they come back just at the same time as bonds, equities, and technology stocks, they are not showing the defensive qualities and the decorrelated qualities that they should show. And this is my problem right now, is that the only thing that I see in cryptocurrencies is beta, is exposure to the market. So if I want high exposure to the market, maybe I want something that is less problematic in terms of liquidity. So I don't think that it's a good sign to see cryptocurrencies recovering simply because everything else is recovering. I see it simply as an example of a very risk-on environment, very aggressive. Signs of stress in financial markets are evident. We are, on the one hand, witnessing an environment in which the very benign views about risk and credit risk in particular, and certainly about mortgage applications, the data about the different aspects that include non-performing loans and certainly defaults, were too optimistic into 2023. And those, all of them, are getting worse. Which doesn't mean we're going to enter into a crisis, but we need to pay attention to this worsening of the credit environment, and for a very simple reason, is that the message coming from central banks is not going to change radically because of a doubling even of non-performing loans or worsening of credit conditions. Therefore, one cannot expect some kind of a bullish view for markets coming from a rise in defaults. That makes absolutely no sense. Therefore, when you think of the current market, you have to look at whether that market is going to react on positive news about the credit market, the macroeconomic environment and earnings, not thinking that it's going to come from a rate cut in the middle of a slump of or a credit crunch.